The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Not as much drama after yesterday's big Fed meeting.
No, and that rally did not last. Take a look at where we stand with the S&P right now. Down 0.4% around the lows of the session. That rally that we saw yesterday kicked off this morning and then slowly has just faded throughout the day. So where's the money going? A little bit into the VIX. We're now back over that 20 level. Also into the front end of the bond market and definitely also into the dollar, really outperforming. So the safe haven assets, again, taking control of this market, Scarlett.
So you look at it, and clearly that post-Fed rally in stocks and bonds was short-lived. Uncertainty rooted in President Trump's trade war, offsetting encouraging data on housing and jobs that really underscore the economy's resilience, at least for now. Sentiment remains fragile as investors hunt for some signs of stabilization. Here's how Blackstone President and COO John Gray describes the macro backdrop.
There's, I'd say, an overall pretty good picture in terms of employment and good momentum, but we are seeing a little bit of a slowdown here. I'd say the positive is that I think the inflation has continued to steadily decline.
The central bank's downgrade of GDP and employment forecasts, coupled with its outlook for faster inflation, is darkening the mood on the small guys. The Russell 2000 entered 2025 with a fairly positive setup, thanks to a recovery in manufacturing and the promise of lower borrowing costs. But the constant on-off tariff headlines have erased that tailwind. Small caps, they're now down about 7% this year. And a big deal on the basketball court. The Boston Celtics sold to a group of investors and a private equity firm for $6.1 billion. That makes it the biggest NBA deal ever, not to mention the largest takeover deal in sports history. In the next hour, we sit down with one of the biggest voices in the business of sports, Marc Lasry, a former co-owner of the Milwaukee Bucks and current chairman and CEO of Avenue Capital. Alex?
All right, Scarlett, let's get back to that small cap point that you are making, because it's not only what we're seeing with tariffs as well as rates, but it also has to do with what the Fed does. This is a great chart that compares the S&P on a price to sales ratio, that's the white line, so basically how expensive small caps are, to the effective Fed funds rate, that's the blue line. Now, in the early aughts, you can kind of see them moving a little bit against each other. So when you had lower rates, small caps did better. Higher rates, small caps did worse. Zero bound rates, small caps performed pretty well. Then you had a move higher in rates, small caps lost the momentum. And then you have another bottom in rates, small caps rally. And now rates continue to creep up, holding relatively steady. Does that mean the small caps just cannot catch a bid? It's like, what is the catalyst for those small cap companies? If you can't get it from the Fed, you're not going to get it from manufacturing right now, and you can't get it from those tariff headlines, Scarlett.
All good questions. So let's put those to Jill Carey Hill. She is head of the U.S. mid-cap strategy over at BofA Securities. Jill, let me pose that question to you. What is the economic catalyst that's going to get small caps going for good here?
You know, I agree. I think small caps have been more sensitive to the Fed and Fed expectations. We saw that with some of the biggest rallies and sell-offs in the Russell last year. Our economists are expecting that the Fed remains on hold from here. So that's, you know, a challenge to the Russell 2000, which has a lot of refinancing risk. And I think, you know, the worry from some investors on small caps is that, you know, what is the catalyst to get these stocks to recover? And, you know, while I do think there are a lot of opportunities within the small and mid cap space, I am cautious on the Russell 2000. I think mid caps are a better risk reward opportunity right now because for small caps, the fundamentals just haven't really turned around. I mean, in addition to the now incremental potential risks from tariff uncertainty and potential risks to EPS from tariffs, you've had a size segment that's still struggled to get out of its earnings recession from 2023. And we're wrapping up the most recent earnings season, and even though for larger companies the commentary was much more positive, the sentiment from management on small cap earnings calls was much more cautious, and guidance has still been cautious as well. So I think we'd want to see revision trends and corporate sentiment turn more positively there. You know, if we do eventually see that pickup in profits growth that everyone's been expecting for a while but keeps getting pushed out.
Right. So that's a pretty long list of things that have to go well for the small caps to really be able to take off. What about the prospect of deregulation and some M&A, especially in, say, the financial sector, where, you know, there's been a lot of hopes baked into this idea that financials will see some consolidation or they'll get benefits from a pickup in deal making?
Right. I mean, I think deregulation could definitely benefit parts of small caps and an M&A pickup as well. M&A, if we do see a pickup, once we get past some of the uncertainty, and we have seen a pickup, over the last year, most of it has been smaller deals. We would expect some pickup this year, but really, there are going to be other factors. The cost of capital is a big driver of M&A. Small cap valuations relative to large, which are still relatively cheap. But longer-term growth expectations for small caps have come down, so that's made the backdrop a bit more challenging. So there is some potential for M&A, and financials, as you mentioned, are a sector within small and mid caps that rank well in our work. I think that is a sector that will benefit from deregulation. Is a higher quality sector. Quality is an attribute that tends to do well when volatility picks up, and that's a sector that generally ranks well across our work as well.
Hey, Jill, the corporate credit market has been a little bit confusing. It's held up really well, and then all of a sudden it didn't start to hold up well, and yields started to move higher, and then it seems to be recovering again. What's the relationship between small caps and credit spreads?
Right. I mean, small caps and high yield credit spreads, you tend to definitely see an inverse correlation there, where when spreads tick up, and as well as when volatility rises, like we've seen, small caps do tend to underperform. When we look at the broader credit risk metrics that we're tracking, not yet flashing warning signs in terms of major credit risk, but you have seen spreads tick up from these very low levels, so that does tend to be more negative for performance. And obviously, it can also impact, that refinancing risk that was mentioned, in addition to rates. The spreads in terms of small caps refinancing risk will be important as well.
What we have seen is, on a large cap level at least, money going into European equities. And I'm wondering if you're seeing something similar. I know that you're the U.S. mid-cap strategist, but are you seeing any money leave the U.S. mids to go to Europe?
Well, I think in speaking with investors, there's been some sentiment that, if the potential for small cap attractive growth M&A candidates is a little bit narrower in the U.S. Than historically, then perhaps, there could be some opportunities abroad. And you have seen some valuation and earnings revision shifts when you look at the U.S. versus Europe. When we've done work with our European strategists on this topic, small caps have been seeing their earnings estimates come down relative to large caps in the U.S., while trends have been a bit better in Europe. But within the U.S., we still think U.S. equities are a high quality area. The Russell 2000, obviously a bit less so, given the high proportion of non-profitable companies in the index. So we do think, mid caps are an area right now that have actually seen better earnings revision trends. There's potential less earnings risk from tariffs in that size segment. They're less levered. So we think mid caps do offer a better risk reward. And if one is an investor within small caps, tilting up toward quality, focusing on areas that may be less at risk from some of the policy uncertainties, financials ranks well, as I mentioned, and some of the value stocks tend to be higher quality than the growth stocks within small caps.
All right, good stuff. Jill, thank you so much. Jill Carey Hill is head of U.S. mid-cap strategy over at Bank of America Securities. Coming up on the close, from small caps to the entire market, we're going to sit down with Mike Wilson, CIO at Morgan Stanley, to discuss why he's warning investors about future volatility. All
right, plus Nike third quarter results due in just about an hour's time. A conversation on if Nike can just do it and beat expectations with an analyst who has an overweight rating on the stock.
And you can't talk Nike without talking sports, and you can't talk sports business without talking to Marc Lasry. And we're lucky because we've got him coming on. A conversation with the chairman and CEO of Avenue Capital in the next hour. This is The Close on Bloomberg.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. I would encourage all of you to be here to cover the White House that day on April 2nd because there will be big announcements when it comes to reciprocal trade. And the president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly. And there will be big tariffs that will be going into effect.
That was White House Press Secretary Caroline Leavitt speaking to reporters this morning on tariffs set to go into effect in less than 2 weeks. After yesterday's rate decision, President Trump urges the Fed to cut rates as U.S. tariffs heat up. Joining us now is Sean West, the author of a book, Unruly, Fighting Back When Politics, AI, and Law Upends the Rules of Business. He's also the co-founder of Hence AI and is a former deputy CEO of Eurasia Group. Really great to get your perspective.
It's such a pleasure to be here.
So, how do CEOs deal with uncertainty? This is max uncertainty. And what we kind of keep hearing is this is the most uncertain business environment they've ever seen, and that there's a pause. Not a dump everything and not run, but not go forward, but a pause. How long does that last?
So I think it lasts until people realize that we're in this for a handful of years and that you can't put your business on hold. Right? If only it were politics that we were dealing with that was uncertain. The politics feels extremely volatile. Markets have reawoken to geopolitics. But we're also dealing with massive uncertainty about the guardrails, as we kind of get into in the book. If the rule and the role of law is different, then as a CEO, your expectations for America are different as well, right? So there's a lot of uncertainty coming at us all at once. We've got technology innovation too that's changing the game as well. And you can't wait. You can't wait on the sidelines, or your competitors, whether they're at home or abroad, will outcompete you. So I think what CEOs are doing right now is they're waiting in their corner and they're developing a strategy. And it's early days in the administration, but I think we're going to see more vocal CEOs in a couple of months on these issues because it's really going to bite.
But meaning that they're sort of getting into a strategy of how they are going to invest within this environment, how they're going to retrench. Like, what's that conversation?
Yeah, so I think there are a few things. Number one, I think there is a redialing of expectations for who's going to carry water politically. So companies have generally done that lobbying themselves. I think there's going to be a real focus on getting industry groups to take more pugnacious positions to protect the industries. Number two, I think there's a question around just how much you want to make sweeping strategic decisions in an environment where they can be reversed. So you'll start to see some rebalancing of supply chains and some movement towards different suppliers, but that'll be based on, I think, much more longer term trends. For instance, we know the US has been diverging from China. Companies understand that. I don't think companies are going to completely deleverage from Canada and Mexico, but they also don't want stockouts. So they've got to do short-term stuff as well. So I think there's really this evaluation companies need to make, which is, if I speak up about politics, it's painful for me. But if I don't, the policies hurt me. And at some point, the policies hurt me even more. And the subtext of the book, the subtitle is Fighting Back, because CEOs are not helpless. And I think a lot of the way we've seen business act in the last few months is they kind of look like they're helpless, like they're kissing the ring and they're quiet. They have a lot of moves.
They have a lot of moves, but they haven't taken them yet. And I'm intrigued by your saying that they're going to get more vocal. What are some of the issues that they are going to be willing to stand up to the administration on?
Well, look, I think you can hear the deafening silence around tariffs right now, which is crazy because tariffs are fundamental to the way that global businesses are distributed. All of the executives that you have on that are running public companies today grew up in the globalization era. Their businesses are globalized. Their mindset is globalized. They cannot accept this as a policy outcome. They're going to get more vocal about that, number one. I think number two, they really want to see Trump deliver on the cuts in taxes and the deregulation that he's promised to do and that he's already poised to do. So I think you're going to see a lot of applauding about that. Right? And that's not just going to be kind of like sycophantic clapping for whatever Trump says. That's going to be really carrying policy water for why lower taxes is better for doing business in America. If the tax rate's down, you can onshore differently. And so even if you're suffering from tariffs, you might actually enjoy a better business environment net. But I don't think any CEO has signed up for a recession. And so the fact that they're quiet now doesn't mean that they're going to remain quiet on those issues. I think they're waiting and hoping that the volatility leads to outcomes that are more positive, right? Because they know that every day there's a new set of headlines, so that they're waiting to open their newspaper to something better coming. But when they realize that it might not be, that these are core tenets of what Trump ran on, of what his mandate is, they're going to speak up against it.
What you said was interesting, that these are CEOs that, grew up in the age of globalization. Does it take a new kind of CEO then for this new era? Someone that hasn't been in the glow of globalization and can think differently and more strategically about the kind of environment we're in, nearshoring or homeshoring?
Well, I actually think it simply takes a different mindset, right? If you treat the U.S. as this exceptional place with open markets and rule of law and all these freedoms, then you're not as successful as if perhaps you cut your teeth operating in emerging markets and operating, if you're, say, a foreign-born CEO or you were a CEO of a foreign company, you understand how to deal with governments that have centralized power. You understand how to deal with governments that don't give you the benefit of the doubt in court, or courts that don't give you the benefit of the doubt. And you size your investments and you size your moves accordingly. So I think it's a shift in mindset. I think right now there was this little bit of a honeymoon where executives thought, well, we can donate some money, we can meet with Trump, we can tell him what we want to do, but then they're still getting whipsawed in the market. And so I think it's a bit about shifting your expectations that you can't half play that game.
Yeah, I was going to say, it's interesting you say that because I was talking to an LNG exporter from Australia, and I was like, you really want to do business in the U.S.? Like, she just made an acquisition. And she's like, well, yeah, there's like still rule of law. Like, the laws change, but there's still laws. Like, versus, say, working in a different country that doesn't even have any of that.
The Wild West,
And so
right?
I was really surprised at how she's like, of course, this is still the easiest place to do business, regardless of all the uncertainty.
It is, but it won't necessarily be forever, right? I think if you undermine the court system, I spent a lot of time in the book digging into the importance of rule of law. We live in a world where we've been experiencing a rule of law recession. That's what the World Justice Project calls it, where more than half of the world has not had access to justice, and those that have, more than half of the countries that have, are seeing a reduction in rule of law. The U.S. is a prime example of that right now. If I get brought into court, I do not know if I'm playing a political game or a legal game anymore.
Right.
And that is a real challenge. So is the U.S. still a good place to do business? Of course. But is it a less good place to do business than it was in December? Potentially. Will we enter Trump's golden age that he promises us a year from now? Perhaps, but we're going to have to restore some of these institutions that are getting dusted up in the process in order to really get the benefits of that. And I think, frankly, one of the big pieces that a foreign company needs to think about also is the immigration policy and the effect on that, too.
All right, lots more to talk about there. Thank you so much, Sean. That's all the time we have for this time around, but we'll definitely have you back on. Sean West is author of Unruly, co-founder as well of Hence AI, and former deputy CEO of Eurasia Group. All right, coming up on The Close, a big day for the big swoosh. We're going to preview what to expect from Nike's latest earnings report due out after the closing bell. This is The Close. It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And we're going to start things off with Affirm. BMO Capital Markets reinstating coverage of the buy now, pay later platform with an outperform rating and a $69 price target. The analyst cites medium-term upside for gross merchandise volume and says the recent pullback in shares creates a compelling buying opportunity. Shares up about 0.5%.
All right, Scarlett, I'm looking at shares of Cava. The fast casual Mediterranean restaurant was raised to overweight from neutral over at JP Morgan. The analyst says Cava is a, quote, buy now and own for the long-term stock and expects long-term upside as the company opens more stores and releases innovative new menus. Shares are up over 5%.
And Alex, let's end things on Coty, an upgrade to buy from neutral over at Citi, which says weakness in its consumer beauty segment is largely reflected in the price. The analyst also sees a large value unlock opportunity with the potential sale of Coty's stake in German hair care company Wella. The price target bumped up to $8 right now. The shares are up about 2.25% at $5.67. And those are some of our top calls.
Another consumer brand that we're looking at is Nike, the footwear and apparel brand, set to release its third quarter report in less than an hour. Now, inventory levels, one of the key factors to watch for in this report, which is something that Nike's been struggling with for quite some time. Joining us now for more is Andreeva, equity research analyst over at Piper Sandler. She currently has an overweight rating on the shares. Is this going to be the trough in sales?
Hi, great to be here. Thank you for having me. No, I don't think this is quite the trough in sales, but we should be getting closer. And I think we should be getting closer to the trough in profitability of the business as well. So I think it's going to be a really interesting print. Some of the things we're watching for. So as you said, Nike is rationalizing inventories. This is a turnaround. They became too reliant on a couple of very big classics franchises that they've talked about, like the Dunk and Air Force One. So getting through those inventories is really important. Watching the inventory levels in North America and in China, that's where, there is still an over-inventoried, situation for the business. Last quarter, I think, is going to be really key. And at the same time, there's new leadership in place. Yeah. We upgraded the stock recently in January, arguing that you have change now. with Elliott Hill at the helm, and Nike is innovating at a faster pace. So listening to some of the green shoots with innovation, we've seen some evidence of that, but it's really early. I think that combined with the rationalization is what's really important.
So, Anna, I know you'll be listening for new product releases, and that's what everyone wants to really hear about in terms of what Nike has to unveil. And of course, they did announce a partnership with Kim Kardashian's Skims business. Is this something that's going to be, they're going to be able to have concrete announcements on this earnings period?
So we're not expecting that quite yet. That is about to be launched. They said spring of 25. So we should be getting pretty close to that. I think it's a really interesting partnership. They've called it, a collection. So it's not just a couple of SKUs. And it sounds like it's going to be a global opportunity and in retail as well as in wholesale. So I think it's super interesting, partnership to watch. But some of the newness that we've been seeing lately that's resonating. Peg Premium is a sneaker that's higher priced that they've talked about that according to our checks is selling through really well. There've been a couple of Jordan releases that are doing very well as well. And company has talked about innovation at scale coming out in the back half of this year and then scaling more into the holiday. So the question is, can Nike be back on offense now and start to gain some of the share that they've lost?
Right. When that offense starts, do tariffs complicate their offense?
Well, yes, for sure. I mean, Nike has not spoken to their exposure yet and has not quantified what that means for the business. They've been minimizing their China exposure, but of course, for footwear, Vietnam and Bangladesh, all of those are really important countries. So we'll be watching what they say about that.
What's the number one thing that Nike's most at risk of right now?
I would say, the trajectory of demand over the last couple of years, there are a lot of brands in this sector, such as Hoka, such as On Running, Adidas seems to be more on offense, that have picked up, a lot of the share that Nike has lost. Brooks and New Balance are two other, privately held companies in the space that have been doing extremely well. So the question is, can Nike begin to matter more, in a consumer's view and gain some of that share. So to us, that's really the most important factor right now.
Anna, we appreciate it. Thank you so much. Anna Andreeva over at Piper Sandler joining us on Nike. All right, coming up, where will markets go this year? Oh yeah, guys, that tease? All right, we're going to pose that question to Mike Wilson, Chief Investment Officer at Morgan Stanley. When you take a look at the market that has lost all steam and you have over $4 trillion in options expiring tomorrow, Scarlett.
That was like a Dr. Seuss question. It's unanswerable right now.
I just complimented them on their teases today, and then look what I get, like a song. All right, much more coming up, Mike Wilson. This is The Close on Bloomberg.
Just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu. We had a Fed-induced rally yesterday, and today it's kind of MIA.
Right. We could have rolled over early, and we just can't seem to get any traction going. And it's really interesting if you take a look at some of the worst performing stocks in the S&P, and they are government related, like Accenture, for example, reporting a slowdown in its U.S. government work due to cost-cutting measures. Also, Gartner, Secretary of Defense, signing a memo directing a termination of over $580 million in DoD contracts. Like, it's starting to filter through to actual numbers.
Well, the government's zeal to reduce costs is definitely playing out in terms of these companies that rely on government contracts. Booz Allen Hamilton, Gartner, McKinsey. I mean, these are companies that will feel the impact.
Yeah, and feel it relatively soon if they're canceling contracts, and obviously exposes that risk. And that's not even counting anything to do with tariffs. So markets got very oversold last week with the S&P touching correction territory. That's from Morgan Stanley saying, quote, "We don't think investors should view a relief rally from oversold levels as a sign that volatility is subsiding in a durable manner. The speed and uncertainty around the new policy introduction is denting investor, consumer, and corporate confidence." For more on this note, it's the author himself, Mike Wilson, Chief Investment Officer over at Morgan Stanley. So where are we right now within the market?
So good afternoon, and thanks for having me on. I think so far the markets have played out, I guess, the way we thought they might have, which is that growth expectations are coming down for all the reasons you mentioned, in addition to the fact that we had kind of a euphoric state at the end of last year. The Fed stopped cutting interest rates in December. And we have this sort of questions around, the sustainability of AI CapEx, growth acceleration. So the market had to absorb all these different things, and that they're all pretty much growth negative in the short term. And that's how we saw it kind of playing out this year. That's 5,500. That was the low end of our range. We got there. Now the question, Alex, as we're kind of going through is, we don't really know yet how this is going to play through into the second and third quarter. So I think it's about time now. Maybe we don't have to take out 5,500. Maybe we do, depending on if the government recession, if you want to call it a government recession, turns into something more broad across the broader economy. And then, of course, the Fed yesterday, kind of showed their hand, I would say. They reduced the balance sheet reduction by $20 billion a month, and that was unexpected. There was also some concern they might take a hike out of their dot plot. They didn't do that. So as we wrote last week, we think maybe there's not a Trump put here as people were kind of hoping for, but the Fed is still there. And if we do have worse growth outcome, I think the Fed will react pretty quickly, like last fall.
So when you mentioned waiting for the good side, right? We tend to think we just got to get past April 2nd. Is it actually going to be later in the year? We actually have to get to tax cuts and deregulation and what that looks like before anything can really be solved?
Yeah, I would suspect that earnings revision breadth, and that's something we track closely, as well as maybe economic surprises, maybe don't start to turn up until the fourth quarter. And in fact, the administration is sort of even targeting that. But remember, stocks are forward thinking. So it doesn't mean that stocks have to languish all the way until the fourth quarter. We could see things start to probably trough out either now in certain circumstances where stocks have really been hit hard, or it may take until the summer or the fall. But it's going to be remember we had a rolling correction. This is going to be a rolling recovery is my best guess.
Okay, a rolling recovery where you see some so-called low-quality stocks driving this short-term rally. What constitutes a low-quality stock, Mike?
Well, I mean, bad balance sheet, too much leverage, low margins, not that profitable. So those are the kinds of stocks that tend to do the best when it's sort of a relief rally. So we're not advocating that those should be core positions, but that, if in fact it is a low quality rally kind of leading us for the next week or two, that will just inform us that we probably have more, wood to chop in terms of the broader market finding its footing and being able to make a march towards new highs. We think new highs are probably out of the question in the first half of this year.
Okay.
But by the second half, it's very plausible as we look forward to 2026.
In the meantime, we've seen the dollar come off its heights, too, from mid-January. It's lost a lot of ground recently. At some point, that recent dollar weakness will help earnings for a lot of the S&P 500 companies that rely on overseas sales, won't it?
That's exactly right. And that was one of our concerns coming into this year, was that the dollar was very high and rates were high. So now that's reversed, right? You have lower rates and you have a lower dollar. And quite frankly, this relative trade versus Europe, I think, could go the other way now as we go into earnings season. I mean, Europe benefited from the stronger dollar, into first quarter, period. And that was one of the big positive drivers for Europe. Now, as they report first quarter earnings, it could be the exact opposite. So that relative trade, we think has kind of gone fully. So I would advocate sort of S&P 500 over Europe now on a rebound trade that direction.
Oh, that's interesting. But then what about all the money that Germany's spending? Like, do you think that doesn't hold enough water to really cycle through the market as much?
Well, Germany's up 17% this year, so I think you've discounted quite a bit of that. And once again, just in the very near term, this is more tactically speaking, that the revision factors for Europe should look weaker relative to the U.S. just based on that currency factor that Scarlett was asking about.
When you take a look at the NASDAQ and Mag 7, say in particular, is that sort of its own beast in essence? Because there was that euphoria and that was, you can make an argument, an overvaluation. Is that a little different from what the rest of the market has to sort of manage right now with that headline risk?
Well, it's interesting you bring up Mag 7 because that too is a situation where the earnings revisions have rolled over harder than the rest of the market, and that's why that group has underperformed. But we're starting to notice now in our data, we look at this daily, that's flattening out now, and that may actually pick up. And remember, the Mag 7 will benefit from that weaker dollar feature. So I think that there may be a trade there as well to maybe kind of buy back into the Mag 7 relative to the 493 or kind of the equal weight where, that we've seen pretty significant underperformance over the last couple of months.
So we have this rally, a recovery rally, but it's not a durable rally as you've seen. That suggests that there's more downside ahead. Do you anticipate next time around that there's going to be more forced selling? I don't get the sense that we got that this last time. And so as a result, we didn't really reach capitulation.
Well, I don't know about that. We got as oversold as we saw during 2022, and we did see some forced selling from some of the systematic strategies and some of the more levered players out there for sure. We definitely didn't see forced selling in the retail community, but we may not see that. The retail community, has made a lot of money the last few years, and they have a lot of cash on the sidelines. So maybe they're in better shape. They don't get to that position. What we're looking for, quite frankly, is not so much technical. It's more on the revision side. We need to see earnings revisions stabilize and then start to turn up again for this to become a rally that can lead to new highs. When I say it's not a durable rally, it doesn't mean we have to go lower. It just means we're going to chop around.
Yes.
And that's a difficult environment. It's a trading environment, and it's fine if you're a trader, but as an investor, it's going to be noisy. And so you don't need to be rash here thinking you're missing something either way. It is a trading environment. Vol's going to stay high, as we said, and we think it will work its way through over the next 2 quarters, and by the second half of the year, we should see better visibility on 26 growth getting better.
So, Mike, which sectors would you want to be in as sectors that may give guidance that, moves to the upside?
So I think, we've been very focused on 4 sectors where the revisions have been quite good. That's financial, software, media, entertainment, and some of the consumer services sectors. Some of those are starting to flatten out a little bit, and then we've seen relative strength now lately in the defensive sectors, most notably utilities and some of the staples areas, not on revisions, but on price. So I think the barbell sort of between those 4 sectors I mentioned where revisions are good and a little bit of defensiveness in the portfolio still makes sense probably going into the second quarter.
All right. Really a pleasure to have you on, Mike. So thank you so much for joining us today. Mike Wilson over at Morgan Stanley talking about this tradable rally, a choppy rally here around the 5,500 level. Coming up on the close, there's a big appetite on Wall Street for Darden today after the restaurant owner reported rosy guidance, why analysts see a bright future for 2 of its biggest brands. That is our stock of the hour today. Up next. All right, shares of Darden are higher by about 5.5% after reporting guidance that shows comp sales could rise about 3% this quarter. Now, Darden owns brands including Olive Garden and Longhorn Steakhouse, both of which are outpacing most of their casual dining peers. Bloomberg Intelligence senior industry analyst Michael Halen predicts that Darden's sales could get a major boost from marketing and delivery orders. Michael is here now for today's stock of the hour. So, Michael, what is Darden doing that's right? What's working?
Yeah, I'd say the biggest thing at Olive Garden right now is really the fact that they've been pricing so much below inflation, and that's across their brands, really. But Darden, they've done a good job of pricing below inflation, pricing below their peers, and they're going to start marketing and spending more on marketing to let the consumer know about it. And so we think that's really going to be a good boost for their same-store sales here in 2020, fiscal 2025 and calendar year 2025 as well. So that's a big one. I'd say generally they're one of the best operators in the business, and you're really seeing that at Longhorn. Longhorn continues to outpace the industry with just very strong sales and service and value for the money.
But what about the margins then? So if they have any sort of tariff risk or risk management on that end, and then you're also spending more on marketing and you're pricing below inflation, how do you margin here?
Well, listen, they have the best restaurant level margins and operating margins in the business. So if anyone can afford to spend a little more on marketing, it's definitely Darden. We've been arguing that they're underspending on marketing for the last few years post-pandemic. So this is more of a renormalization in our opinion, and I think it's going to help them gain market share throughout the year. They did talk about tariffs a little bit, and so Olive Garden and is an Italian concept, right? And so Olive Garden and some other of their chains import items from overseas. They probably import more than most of the chains we cover. They said about 20% of their product is imported, but they said a lot of that is actually just being imported because it's cheaper. And so they don't have a ton of exposure. Most of the restaurant industry doesn't to the tariff issues. And what they're doing right now is just basically expanding the number of suppliers that they use to help mitigate some of the risks that they have.
So it sounds like operationally they're executing that in an optimal way, which is great. But how can they be more opportunistic going forward? You said that they're going to increase spending on marketing to really tell the consumer that they're able to keep their prices below the rate of inflation and their peers. But what else can they do? Are they going to expand more? Are they going to innovate with their menu?
Uber Eats, that's I'd say number 2 behind marketing. So they took their time getting into the delivery business. It's all through their own app, right? So they're not joining the delivery marketplace of Uber Eats, which really crimps margins. And they've started getting some marketing support from Uber, and quickly, the 100 stores that they piloted this test in are already doing 2.5% of sales at delivery. And I think they were really smart about the way they implemented it. They're doing it with the curbside to go. So it's not hurting operations in the restaurant. They don't have to worry about Uber drivers coming in and out of the store and clogging up the front of the house. And so it looks to be paying some early dividends.
All right. Hey, Michael, really appreciate it. Michael Halen with Bloomberg Intelligence. Darden stock is up 5.5%. All right, we're 15 minutes away from the closing bell on this extraordinarily unremarkable Thursday. Marc Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors, will be joining us. This is The Close on Bloomberg.
While I do think there are a lot of opportunities within the small and mid-cap space, I am cautious on the Russell 2000. I think mid-caps are a better risk-reward opportunity right now because for small caps, the fundamentals just haven't really turned around. I mean, in addition to the now incremental potential risks from tariff uncertainty and potential risks to EPS from tariffs, you've had a size segment that's still struggled to get out of its earnings recession from 2023.
And that was Jill Carey Hill, head of U.S. mid-cap strategy at Bank of America Securities, kicking off the show, saying she prefers mid-caps right now. I mean, everyone we've talked to so far has just come to this conclusion that we're in this choppy market right now. Everyone's waiting until April 2nd.
I know, but the S&P really wanting to turn positive today, I got to say. We're now down just 0.2%. We opened lower. It looked like we were going to mount a rally, kind of continuing on where we ended yesterday. And then we kind of rolled over, but now we are off the lows of the session. Some of the stocks within the index, it's really energy that's leading within the S&P, which is really interesting because energy in general has been beating the S&P. Is that where you go if you're going to have a stagflation environment? Tech still underperforming, and the semis, although off the lows, still it's not a great day for the semis.
Yeah, these are pretty modest moves, muted moves in the market today. So let's bring in a technician here for more market analysis. Marc Newton is Managing Director, Global Head of Technical Strategy at Fundstrat Global Advisors. And I bring up the technical part of it because when there's a lack of fundamental catalysts, people look to levels as potential catalysts here. There was some technical damage done during the recent sell-off, right? I mean, the S&P 500, the NASDAQ 100, the Russell 1000 Growth and Russell 1000 Value all fell below their 200-day moving average. How much damage was done?
In the short term, there was a lot of damage, specifically in technology, but that's mainly short term. Intermediate term basis, I would argue that not hardly any damage was done to the bigger picture. When you look at many of these stocks that represent the Mag 7, they've all held their longer term uptrends, which I think is important. We never really saw any indication of high yield widening out all that meaningfully, which I think would be a warning sign, potentially a dislocation in the fixed income, that we'd see a broader sell-off to come. And honestly, sentiment is about as negative as I've ever seen it. I mean, based on a number of different retail gauges, and the Bank of America report came out the other day saying that there was massive reallocation out of U.S. stocks. So I think that is interesting at a time when valuations are certainly much more in line. We're still getting the majority of the earnings strength out of the technology sector. And most of those stocks are down to levels that are actually quite appealing. So I find that to be honestly a great sign and honestly some recent signs of bottoming out, which for me are very encouraging.
So the other side, if we look at sort of the issues, is that not a large percentage are below their 200-day moving average within the S&P. There's like a lot of other things to point to that like this doesn't look as bad as usual when we have capitulation. What do you say to that?
Yeah, that's true. Look, it hasn't been a 50% decline. So a lot of people are looking at this 10% decline saying, well, there's no true capitulation like we've seen at the end of 2009 or the end of 2003. And I don't think those things are going to happen during this. I think we're going to start to turn up regardless. We've already seen the bell going off for a couple different reasons. One is that equity put to call did get up near 1. It was as high as it's been, of course, during last August and in this past January, last April. The market all bottomed during those times after minor pullbacks. And we've also seen a very good move off the lows. Breadth improved materially. We saw advanced decline getting up above 90% of all issues on consecutive days. Normally, that's a big sign that we were likely starting to bottom, if not have bottomed, in my view, after in a rampant atmosphere of pessimism. So I'm encouraged. The breadth never got as bad, and arguably because it wasn't the broader market. It was literally just tech and large cap financials that let us down. And there are a number of sectors that held up. I mean, financials, uptrends, and industrials are all still in great shape, discretionary. And if tariffs are truly the issue, you look at all these other countries and their equity markets are up 10, 15, 20%. So it was mainly just a U.S. correction, not really anything that happened in Europe or in Asia. And I think that's also very
a little bit less of that American exceptionalism right now. In terms of forced selling, it doesn't seem like we've seen that just yet, but I'm wondering what that looks like technically, forced selling or disorderly moves lower. How does that show up?
Well, usually I look at the trend or the ARMS index, and you do tend to see movement over 2.5 as being important, where you see almost all the volume happening on the downside, and that will say, well, it's real capitulation. And we never really saw that in the NYSE, but also I don't know that needs to be important. Oftentimes it's just a drying up of the selling on the downside, and valuations are in line. We've seen less selling, and now we've seen a decent rebound in the last week where tech, to its credit, has actually held up quite well. And so for me, I think we're bottoming out, and honestly, I think a lot of people are waiting for April the 2nd, and I don't know that we're going to get there. I think we're starting to turn up, and it's important.
Okay, so that's a good point. So we're waiting for April 2nd and then to put on a position, but you're saying that we've kind of bottomed out here and we could actually turn up more meaningfully before April 2nd. Am I hearing you right?
I do think that's correct. Okay. I think 5,500 holds, and in the event that it doesn't, there might be a fractional. We might have 3% downside maximum, whereas I think the upside is 9, 10%. We're going to get back to new all-time highs.
Which asset classes are you looking at most carefully to, suss out correlations with the equity market?
Yeah, that's a great question. I think that ordinarily we've seen pretty good correlation between treasuries and equities, and that's really come unwound. Now we've seen treasuries largely stop their advance just at the time when Europe is starting to argue about expanding fiscal policy and Germany's going after defense. So, I still would look at just, what's happening with technology. Most of the leading sectors are still in good shape. Technology, discretionary, industrials. I don't know about correlations versus other asset classes per se, but treasuries and the dollar are usually, yields in the dollar both pull back together. Now they're stalling, and now equities seem to be trying to bottom out. So the correlation could briefly invert. Temporarily. All this money went overseas. Now I see it an excellent opportunity to invest in the U.S. at a time when everybody's favoring China, favoring Europe, that rallied as the euro was falling. And now all of a sudden we're starting to see, in my view, a great risk reward for U.S. equities.
I mean, that's what Mike Wilson was saying from Morgan Stanley, right? Like it's time for the U.S. To come back after all that money went to Europe. Real quick, what sectors lead that potential 8 to 10% upside?
I still love technology. I think it's hard to avoid. I want to buy financials. They led in Europe. I want to buy tech. I would avoid consumer staples. We've specifically in the last week seen good signs of discretionary trying to bottom out versus staples. That's a good risk on, risk off type ratio that I often watch. And so discretionary, to its credit, should start to come back here. The consumer should be still in good shape. Earnings are good. I mean, we heard that out of the Fed. We saw jobless claims basically come in okay, and it underscored Powell's thinking that despite jitters about tariffs, he's not in a hurry to cut rates.
All right, Marc, it was really good to see you. Thanks for coming in.
Thank you.
Great insight. Marc Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Interesting stuff that we had two people say, okay, I think it's time. Like maybe we can start to see the rotation back into the U.S.
And I love the fact that we're in this kind of holding pattern right now, waiting for something to happen. So you have to meld the fundamental and the technical. The fact that Marc brings in the fundamental analysis into watching levels is great.
I love technicals. I've always loved technicals because, selling and buying happens on those numbers and those lines.
Lots of positions change
Lines
hands.
are important. All right.
Lines are important.
S&P pretty much trying to be positive, can't quite get there. Closing bell up next.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele here alongside Scarlett Fu here to help take you through the closing bell in a global simulcast. We're joined now by Carol Massar and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide. We're going to parse through the most crucial moments of the trading day. Guys, S&P cannot close in positive territory, it looks like. Really made a run for it, though.
Yeah, I mean, certainly trying, right? But what a kind of limpy day. Having said that, there are some stocks that we've definitely seen kind of move big time to the upside or to the downside. We'll get into that in just a moment, but it just feels like, Tim, a market looking for direction.
Yeah, maybe earnings after the bell will provide a little direction. A check on the consumer with Nike. We get some tech with Micron. We get an idea of what people are sending and transports with FedEx. I don't know, though.
There's not a whole lot of conviction out there, and you see it reflected in the price action across equities and across all the other asset classes. And of course, April 2nd seems to be the date looming over everyone's head. People seem to think that we're going to get some clarity. I don't know if that's the case.
No, we talked to Mike Wilson at Morgan Stanley and Mark Newton of Fundstrat, and both of them were saying maybe we kind of troughed here, bottomed out. Time to kind of bring money back into the U.S. from that way. Maybe tech, maybe financials. That was kind of interesting.
On the negative side, we talked with Peter Atwater over at William & Mary, and he has his own investment firm. And we talked to him about maybe is the U.S. market becoming uninvestable, which is, he kind of said yes, or possibly. So
really?
Yeah.
In favor of Europe? Other markets?
Yeah, other markets. Like time to look outside. Yeah.
Anything but.
One of the possibilities he sees.
One of the possibilities. All right, guys, there it is. The closing bell. Womp womp. Could not get there. S&P closing down by about 0.2%. Tried to make a run into positive territory earlier in the day. Just could not hold it. The Nasdaq off by about 0.4%. But off the lows of the session there, the Dow is pretty much flat. But guys, it's kind of across the board. The Russell underperforming, mid caps underperforming, and the equal weighted down by about the same as the S&P guys.
Micron is out. I'm just going to kind of run to those earnings just because they just crossed the Bloomberg terminal.
Go for it.
Certainly one. Second quarter adjusted EPS, guys, $1.56. That's a beat. $1.43 is what the street was looking for. Let me go to the outlook because that's what the street always cares about. Micron sees third quarter adjusted revenue of $8.6 billion to $9 billion. So that is above the street estimate of $8.55 billion. You are seeing the stock up about 2.5% in the aftermarket. Going back to the last quarter, second quarter adjusted revenue, that came in better than what the street was expecting, $8.05 billion versus $7.91 billion. And second quarter adjusted gross margin, 37.9%, a little bit light. Street was looking for 38.4%. But again, it looks like, guys, investors focusing on that outlook, also saying on track for significantly improved profitability. So investors seem to like what they are getting from the company. All right, let's go back to the market, guys, because as we said, it does feel like a market that is looking for something to give it some clearer direction at this point. Having said that, most names in the S&P 500, Scarlett, lower today, 318 to the downside, 178 to the upside.
All right, let's take a look at the IMAP, which looks at the 11 sectors in the S&P 500. A real mixed bag here, but what's notable is that none of the industries moved more than 0.6%. Your best performers, energy, utilities, gaining about 0.4%. Financials, barely higher by 0.2%. The decliners, materials losing about 2/3%, staples down 0.5%, along with technology off of by 0.5%.
All right, a lot of red there, and I got to say some of my gainers were more in the green earlier today. Take Five Below, up almost 9% at its highs today, finishing the day with just a gain of about 0.7%, so well off its best levels of the session. Discount retailer, we broke the earnings after the close last night, did report fourth quarter results that beat expectations. Still, some analysts are cautious about the outlook. We got some more earnings.
Yeah, we have FedEx reporting, of course, a bellwether for the economy. Let's start with the third quarter adjusted EPS, $4.51, missing the consensus estimate by 6 cents. The operating margin for the third quarter was 6.8%, also below the expected 7.06%. Revenue for the period, $22.2 billion. That was higher than anticipated. FedEx is progressing its FedEx Freight spinoff preparation, so that is still moving as planned. As for the full year outlook, adjusted EPS will be $18 to $18.60 a share. Previously, it saw $19 to $20, so that probably accounts for the 2.9% drop you're seeing in after-hours trading.
Yeah, I just want to mention some commentary. The company saying our revised earnings outlook reflects continued weakness and uncertainty in the U.S. industrial economy, which is constraining demand for our business-to-business services. They say, despite this uncertainty, I'm confident we are well positioned to execute on our transformation. But, once again, we're getting commentary certainly about the economy. And as you guys said, stock is down here in the post-market, down about 3%. Company also saying sees fiscal year adjusted EPS $18 to $18.60 a share. It had seen $19 to $20 a share. So again, now the stock down more than 4%. So that's kind of a negative tone, to say the least. All right, I'm going to go back to some gainers. There were a few. Meta Platforms, again, up about 4.5% at its highs today, finishing with just a gain of about 1/3%. You can just see the negative tone in the market, even after stocks that were rallying earlier in the session. Not quite sure why, although we did see Meta AI's intelligent chat function is going to be rolled out across 21 overseas territories and available in 6 European languages, according to a statement. So they continue to spread that out. And then Darden did hold on to most of its gains, up about 6% here at the close. Did hit a 52-week high today. Company saying on the conference call that its implied fourth quarter guidance includes comp sales growth above 3%, which is ahead of the consensus view of 2.3%. Keep in mind, the stock was up more than 8%, but still, Tim, finishing with a gain of just shy of 6% today.
Okay, you got the gainers, I got the decliners today. I had to do some last-minute shuffling because of a little buying toward the end of the day, but no worries, everything's in the red still. Apple down by 0.5 percentage point today. It was down more earlier in the session, but we saw some buying late into the close. Bloomberg's Mark Gurman reported that Apple is undergoing this rare executive shakeup when it comes to AI. Mike Rockwell is taking over Siri and reporting to software chief Craig Federighi, removing Siri and AI's head from his command. So that's a rare executive shakeup there. Investors sending shares down by about 0.5 percentage point today, down 14.5% so far this year. Want to take a look also at what happened with Accenture today. We'll do that in a second. Starting with D-Wave, though. D-Wave Quantum down 18% today. Quantum computing shares sank today. This after industry leaders spoke at the NVIDIA GTC event. Jensen Huang was there as well. It's part of this chipmakers week-long conference. Remember, in January, Huang sparked a sell-off in quantum computing related stocks after saying, quote, very useful quantum computers were probably decades away. The comments today didn't help the quantum stocks that much. Once again, D-Wave Computing down about 18%. And finally, what happened with Accenture today is really interesting. In the commentary that we got, shares fell by more than 7% today. These are ADRs after the company reported a slowdown in its U.S. government work due to DOGE cuts, including a decrease in new procurement actions amid President Trump's spending crackdown. Accenture anticipates ongoing uncertainty in its government work as the administration's priorities evolve, and it's updated its risk factors to include the risks inherent in government contracting and the government contracting environment.
Yeah, there's like two sides, right? You got the FedEx, which is reflecting the macro business environment, and then you have the specifics from companies that have been hurt by that. Okay, let's go to the bond market. Nothing happening. It was a snoozer, but a little bit of buying in the front end. That was the best I can get for you. 10-year yield, though, quite interesting. So Ira Jersey of Bloomberg Intelligence was saying, look, we probably put in the high for the 10-year. We just need to find the bottom for the 10-year, but the action now, because of the economic conditions and the Fed, is really going to come in the 2-year. So watch that space.
All right, got to look for some stories that kind of make us happy today. And it certainly here's a story that made a worker over in Canada really happy. His name is Charles Coffey. He's 81. He's a former Royal Bank of Canada executive. He's been there for a long, long time. Turns out he won the top prize in the Ontario lottery. And Tim, that meant a fair amount of money.
He first thought he'd won only $25,000 Canadian. But then he got his glasses, he took a closer look.
Oh my goodness, so sweet.
It was actually $25 million Canadian, which, quick math, $17.4 million US. He's 81 years old, and he's long talked about what he's done with philanthropy and giving, and he said this gives him an opportunity to support causes, but first he's going to take his kids or his family on vacation.
I love that. Is he going to take them out of Canada or stay in Canada?
Probably not in the U.S.
Yeah, given what's
just
happening.
Paraphrasing.
But that's a great story. It's a feel-good story, and I think we all need feel-good stories right now.
Agreed. What do you guys got?
What do we have?
Oh, Finland.
Oh,
this is yours.
Yes.
Yeah. Finland. So
this is a regular thing.
Finland has been ranked as the world's happiest country for an 8th year. U.S. falling to
24th
24,
place,
25 ever level.
But look at that chart, right? For those on radio, number 1, Finland, number 2, Denmark, number 3, Iceland, number 4, Sweden. What do they all have in common? They're all in the Nordic region.
Yeah, which is weird because it's cold there.
Yeah, but they have that, was it Hygge?
They also have
the coziness
They also
factor.
have a pretty robust capital markets, right? So you actually can get like innovation and technology companies, like a lot of the small ones, like are also from there, which is actually just
And they have
cool.
a social safety net too, provided by the state.
All right, let's
What
go.
about the weather, though? What about the weather?
Chilly.
Yeah.
It's cold.
Long
we
nights.
agree with you.
Long
we agree
nights.
with you.
Long winters.
But they're still happy.
Just one last thing. Did you see that believing that others will return your lost wallet is like a key indicator of figuring out like happiness or a population happiness?
But they don't use cash anymore, right? Don't they all use
Maybe that's why it makes them
Bitcoin
happier.
and crypto and electronic
you got
money?
IDs in there, those stupid coupons you put in there?
Maybe.
All right, guys.
Everyone likes coupons.
I'm a little bit happier right
On
now
your phone,
because of
though.
these stories. All right, we got to go. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. We'll see you again. Same time, same place tomorrow.
All right, coming up, we are going to talk about the business of sports with Marc Lasry, co-founder and CEO of Avenue Capital Group, former co-owner of the Milwaukee Bucks. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. Let's take a look at where markets did nothing all day. All right, the S&P closing out just down by about 0.2%. Tried to make a run for it early in the morning and then has rolled over and could not get into positive territory. Bond market, only the front end, a minor bid. The dollar performing pretty well. And gold at one point did hit a record, but kind of rolled off. But that is a very, very non-active board.
Yeah, very, very muted price action. So let's move on to some individual movers, a little bit bigger moves here. Accenture, these are the ADRs of the consultancy company, dropping the most in a year after saying that the U.S. government work is slowing down because of Elon Musk's cost-cutting push. Federal services make up about 8% of revenue and 16% of U.S. revenue last year. We saw other companies that also do similar work on government contracts like Booz Allen Hamilton and IBM declining. And Jabil Circuit, now just called Jabil Inc., up about 3%. It did rise as much as 6.3%. The electronics maker had a beat and raise quarter that impressed investors and really serves as a clear contrast to the general pessimism over the broader economy that's taken root. But let's move on to our top story this hour, because private equity is making a big splash in pro sports with two major deals in basketball and baseball this week. The Boston Celtics today reaching agreement to be sold to a consortium for $6.1 billion, making it the largest sports takeover deal ever. While 2 days earlier, the San Francisco Giants announced they sold a 10% stake to Sixth Street Partners. We're so pleased now to bring in one of the savviest investors in sports, and he is Marc Lasry. Marc bought a 25% stake in the Milwaukee Bucks in 2014. He sold it 9 years later in 2023. Marc is chairman and CEO of Avenue Capital, which has its own sports fund. Great to see you.
My pleasure. Thank you for having me.
So let's talk about that $6.1 billion price tag for the Celtics. The Washington Commanders fetch, $6.05 billion, so this is the biggest deal. The Celtics might be reigning champions on the court, but they don't own their own court at TD Garden. So I'm curious what you make of this price tag.
Look, I think it's a great price for the league, and you had 4 people who wanted to buy it. So it was a competitive process. The fact that they got $6.1 billion, it's great for the holders, for the folks who own the Celtics today. But I think it's a high price, but it seems that's where teams are selling for today.
Back in the day, you had said that you paid too much for the Bucks, and at least at the time you thought you did. I guess when it comes to wondering whether they paid too much for the Celtics this time around, because the real estate was not part of that component, I got to wonder, how much more should it have been if there was real estate involved?
It probably would have been more, because you would have made more on the team because of owning TD or the Garden.
Yeah.
And the question is, will they try to build their own arena? And they may do that. But at the end of the day, like when we bought the Bucks, we had paid the most for any NBA team, and that was about $550 million. Today,
that's funny now.
I know, no, it does. It sounds funny. And when I sold, I thought that was a great price, around 3.5. So, look, I knew at the time that when we sold, prices would probably go up. I think because of the new media deal that got done, prices have gone up a lot more. Yeah. I thought Adam Silver had done a phenomenal job in getting that new media deal. And I think that's what's spurring these new prices.
All right, we just have some breaking news for us here. It's Nike. Just going to give out the earnings here. Nike third quarter earnings comes in at 54 cents a share, well below estimates, about 77 cents a share. Revenue, a little better than estimated, though, coming in $11.27 billion. We were looking for about $11 billion estimate, so definitely better. China, though, not great. That EBIT coming in at $421 million in inventory. Still a little high at 7.5 billion. Looking at that stock, though, pretty much flat, so digesting that reaction. Marc, does this make you want to get back into pro NBA?
Yeah, look, I think there's a lot of growth that's still going to happen. I think part of it is going to be hopefully when they end up having an expansion team. We've been looking at Vegas, so we'll end up seeing what happens.
But you think that the froth is done at some point? I'm just trying to understand how you can suck more value out of something that doesn't have the real estate yet. How do you get more value from them? Well,
I think the way you'll get more value, look, you only make money in sports 3 ways. So it's ticket sales, sponsorship, and media. So if the Celtics win again, they'll be able to raise ticket prices anywhere between 10 to 20%. If you have a team that's the worst in the league, that team is still raising prices 5-10%. Nobody stops giving up on their team. It's actually one of the great little secrets about pro sports. Every year, the whole mantra in sports is next year is our year, right? And everybody believes that. So I think you're always going to see that teams are going to keep on growing at sort of anywhere between 10% to 15%. I think if you own the real estate, you'll end up growing faster because you can end up having concerts. You can do everything within your own arena. So I wouldn't be surprised if ultimately the Celtics end up building their own arena.
When it comes to the Vegas franchise that you're considering, that you're weighing, have you thought about where that franchise would play?
Yeah, we've been looking at a bunch of areas in Vegas. I don't want to talk about it because if I do, then those guys will raise the price of where.
That's how it usually works.
Yeah, that's usually how it works. But I think for everybody who does something in Vegas, it'll be at the T-Mobile Arena, at least for the next few years, until people are able to figure out where they want to move the team to.
All the sports franchises are looking overseas to expand their brand and their market. The LA Dodgers with Shohei is a perfect example, right? They've got this built-in Asian fan base. What's the single best way of doing that for teams that maybe aren't obvious candidates for international fans?
Well, I think first, if you win, people love that, right? So for us, we had Giannis. And because we had Giannis, you wanted to play games in Greece. We never did, but we ended up playing in Europe. We ended up playing in Paris. We played in London. So part of when you have international players, wherever they are, you want to try to end up playing there because it just feeds that popularity. So I think for every team, what you want to do is you want to grow outside your market you want to grow in the US, and then you want to grow internationally. And a lot of that is the media. And that's sort of what everybody is seeing, that all these teams are becoming global in scope as opposed to what they were, which was national in scope.
Or even regional.
Or even regional. I agree with that.
What are you most excited about right now?
For us?
Yeah.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. We ended up investing in the Orioles, and we're very excited about that. But in a number of the investments we've made, we've already seen prices that have gone up already about 50% plus. Wow. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially. Right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown. Like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I didn't know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
So you own little bits, and then it grows exponentially. What area would you not touch right now in sports?
I don't want to touch leagues or teams where we think you've got flat growth.
Okay.
Right? So when you're doing a new league or new team like TGL, we ended up doing that, the golf league that Tiger and Rory started. A lot of that was how many people were going to watch it. And what you've seen is they've had great growth. Over the course of the year, just had the semifinals. The finals are going to be this Tuesday. It's actually been going great. And you've had more people tuning in than you thought. Originally, we thought it'd be 250 to 500, and it's been about 750 to 1 million. So that's letting you know that people love it and people want to be a part of it.
When it comes to TGL, it's a new simulator golf league. It feels like the ticket sales might be capped, right? Because it's in this arena. So then you have to really rely on those other two legs of the stool that you were talking about, media and sponsorship, to really, really grow that business. How is that looking right now? I mean, this is the first season, so you've just gotten started.
We've gotten started. What's happened is you've had more people watching it. And as more people watching it, you end up having more sponsors who want to be a part of that. So it's actually gone far better than we thought. And, the only problem with it, I would tell you, is we lost our match a couple days ago. Yeah. I thought it would have been nice to win.
You did make it to the playoffs, though.
We did. But Stevie Cohen's in the playoffs. Arthur Blank's in the playoffs. So we'll see who ends up winning. But that'll be a pretty nice championship for either one of them.
I'm just really into the fact that you can watch it in 2 hours. Like, that's huge.
But that was the whole key to it.
That's a game changer for me.
No, it is. And that's exactly it. Because the problem I think that TV or media had with golf was it was 3 or 4 or 5 hours.
Interminable.
Forever.
It was long.
It was forever. Yes.
So now that it's 2 hours, you've got a lot more people watching, and they love it, and they love the interaction between the players.
You've also invested in women's sports, and I know that you're looking at that very carefully. Where are we in the trajectory of the valuation of those teams? Are we in like the second inning, the sixth inning?
I think you're in the first inning.
I
really do. If you think about it, 5 years ago, you could have bought a women's soccer team for $1 million. Today, they're trading around 150 million. We've ended up starting to buy women's soccer teams in Europe. And part of the reason for that is we think right now they're undervalued. But we've invested in Unrivaled. You want to invest in women's sports. And the reason you do, so here's a nice little tidbit of information. When Caitlin Clark played in the women's final in college, you had close to 19 million people who watched that. By the way, that is more than I've ever watched a Stanley Cup Finals game, more than I've watched a World Series game, right? So, and it's pretty much almost as much as watching NBA Finals. So that's great. The fact that you ended up having a women's NCAA basketball game and you had all those people come, what it's telling you is there really is a change that's happening. And that change is very simple. When I was a kid, if I went to a baseball game or a football game, my dad didn't bring my sisters. It was him and I. Today, the idea that you would not bring your daughters is inconceivable to someone. And so because of that, your daughters are going to games, they're playing, so it's actually been great.
Oh, sorry, the Stanley Cup, that was hurtful for Scarlett. But anyway, this is where I'm going to pair sports with the macro environment.
Okay.
A lot of uncertainty. CEOs are on the pause button all the way. How does that and all the uncertainty in DC affect sports? Like, how do you view through that lens?
I think it's the one thing that people...
It's immune?
I would never tell you something's immune, but I would tell you for the short term, I think it is. But part of that is because people want to be part of something. They love sports. They love going. So I think you're always going to have that. Look, during COVID, it was actually kind of interesting. During COVID, people wouldn't come into the office, but they would go to a stadium. They'd go to an arena. They'd go to, it was outside. So you still had 30, 40, 50,000 people showing up. What that tells you is people want to be part of that, and they're always going to want to be part of their sports team.
Do you find better value in sports assets right now than in the conventional markets, the public markets, or private assets, debt, anything else? I think depending on where you're investing in sports. So I think in our core business, we're able to make about 10, 15% a year because really what we're doing is lending money. I think in sports, especially in sort of emerging leagues, you can make multiples of that. You can make sort of 10, 20 times your money. And I think in sort of the big four, over 20 years, the IRR of that's been about 11%. So if I think over the course of the next 10 years, I'm still going to make 10, 15 in sort of the big four, I would do that. Interesting.
Broadening out, because for our broader viewers, what do you like in the non-sports market right now?
Well, really what we love is lending.
Yeah.
And the reason we love lending...
You and a lot of other people right now.
Yeah, but the reason for that is you're not taking the equity risk. Right? And if you can make, in today's environment, if you can make 10, 15%, people want that. Right? It's very safe. You're not taking as much risk. And when people are nervous, what they want to do is take less risk. So for us, we're able to lend and sort of generate those returns. So that's really positive.
What do you need to see for people to be, and you, to be more willing to take on risk then at this point?
I think what you want to see is you want to see positive GDP growth. You want to sort of see in excess of 2%. Part of it is really what's going to happen to interest rates.
Yeah.
Right? The lower rates are, the more people are going to take risk because there's just more capital. The higher rates are, the more people are just waiting. And that's sort of what you're seeing today.
I'd love to just, as we wrap up, get your perspective on the uncertainty that we're seeing in the markets and the economy today versus any other time. Like, you've lived through a lot of cycles. How does this compare?
Oh, I don't think this is
that big of a deal?
No, I really don't. You've had real recessions. You've had real issues in my career. I think what you're looking at today is just, it's a little bit of what you said. People are nervous, so people are waiting. The real question is, how long do they wait? Do they wait 3 months, 6 months, a year, 2 years? If you're waiting a long time, then you've got a real recession. If it's 3 to 6 months, then what you've got is sort of GDP that's flat, up 1%. I would be more nervous if 6 months from now I'm back, and in essence, people are still nervous.
Right.
Right? That's what you've got to look at. So that's what I would try to do.
And of course, it all depends on what this guy on the screen says and does to get us to that 6 months clarity.
And he's obviously coming back now in 6 months. So thanks for that deep tease.
Thank you.
Thank you so much. A pleasure
My
spending
pleasure.
time with you. Marc Lasry is Chairman and CEO of Avenue Capital.